Welcome back to Bunnex Investment Group. In this video, we are going to talk about market structure, actually institutional market structure. So basically, markets are driven by imbalances in the distribution of buys and sells. It's basically when we buy more, we increase demand for a particular currency, and when we sell, we actually introduce much more supply within the balance. So if demand for a particular asset becomes higher than its supply, it means its value rises. And the value in the rise in value will not be linear. In actual fact, we would expect to see a jump from $1 to $10, from $10 to 20, with equivalent magnitude, but it creates upward or downward ripples that gives rise to what we call market structure. Basically, something jagged like this. So if you master higher time frame market structure, your trading will significantly improve through higher reward to risk ratios. If you can actually understand where you are within the market structure, or in other words, where you are within the cycles, you are definitely going to catch entries that can last for a long period of time, and with that you can obtain higher reward to risk ratio. 5 to 1, 10 to 1 is actually possible with higher time frame. So in this video, we'll go through an in-depth on this subject. So be sure to have somewhere to take some notes so that you fully comprehend everything that we would have said. Firstly, the starting point. When we are given any tradable asset, do we know what we do? That's the very first thing that is required for us to get the rightful entries. So when we talk of market structure, we need to have an objective point of starting our analysis. Where are we going to start our analysis? If you watched our previous video, you understand that institutions only trade after accumulation. We defined accumulation as a point or a phase within the market whereby the opening price is almost equal to the closing price. If the opening price of a day is equal to the closing price of a day, whatever that happened within this middle part is not necessary. What is necessary is the opening price and the closing price, and therefore we would have obtained what we call accumulation. And we are saying institutions will only trade after this has happened. Why? For their contracts to be filled, they need trades or contracts to counter. So the simplest and fastest accumulation is basically an M or W pattern. M pattern or W pattern. It's actually the fastest accumulation that can be seen on the markets, or basically a phase where the opening price and the closing price is equal, is what I've just illustrated here. So it's either we get an M or W, or basically an accumulation, which is a consolidation phase. So break of the neckline of an M or W, or basically break of the high or low of an accumulation phase, is the starting point of our analysis. And this is illustrated in the next slide. So whenever we see break of a neckline, which is break of this particular point on a W pattern, we now have obtained the primary bias of the market. Or if we are within an accumulation phase like this, if we break the high of that accumulation phase, we have as well obtained the primary bias of the institutions. So this is basically the illustration of everything that I've just said. This is an M pattern where we break the neckline of that particular M pattern, we obtain the primary bias, as well as if we break the low of an accumulation phase, we obtain the primary bias of the institutions. But wait, we haven't talked on where to make an entry. And I'm sure you've actually seen several setups like this or several explanations like this, but those kind of explanations will not give you the accurate point where institutions actually introduce their funds. So sit back as we continue so that I can show you that exact point up to the examples on real markets. All right. So you're probably asking yourself about this time frame of observation. Which time frame are you going to be viewing all this stuff that we are talking about? Institutions are not gamblers or spike junkies that trades off smaller time frames. I've seen other people who say I focus on M1 time frame. In that particular case, I would love to see their trading results, because most of the times when you are focusing on such small time frames, you will be actually gambling. We dwell much on smaller time frames, and these trap us since we will not be aware of the market structure we are in. Market structure, or basically market cycle, is what is very necessary for us to get right entries. So at one point, you would start to accuse the market of market manipulation, because when you buy, it sells, and when you sell, it buys. It's all because you are in small time frame chops, right? If you are in an M15 time frame chop, you can actually spend the war day trying to get whether it's going to the upside or downside and so forth. And at the end of that particular day, you would have probably lost a lot of money and start to accuse the markets of manipulation. Institutions make their decisions off the H4 time frame or 4-hour time frame, nicknamed the weekly ground. So the institutions always use higher time frames when actually basing or when actually positioning themselves to get into the market. The H4 time frame actually accumulates enough contracts that will fill their orders. So whenever they are actually performing what we call cyclic trading, they do not do so on very small time frames like M1, M5, and so forth. They do such practices on higher time frame, the H4 time frame, the daily time frame. But for this particular lecture, we are talking of the H4 time frame, which is right for you to actually make rightful entries. So within that, we use the Fibonacci retracement level 2. It's actually a very common tool and is available for free to every trader. As mentioned earlier, break of higher time frame market structure provides information on the institutional bias. The next thing after break of structure is to find points of market entry. We now want to find points. Where are we going to make our entry after we've seen break of structure? These are end of retracement points and are obtained using the Fibonacci psychological points. We are saying when we actually get a break of market structure, the next thing is we expect to enter at the end of a retracement like this one. So how do we get this end of a retracement? We use the Fibonacci retracement level 2, which simplifies how we see it. And I'll definitely explain this shortly. So to summarize everything that we've just said, we are saying see the H4 time frame break of structure. 1, 2, get market bias. Are we going up or down? 3, wait for retracement. 4, anticipate entry at Fib level, psychological level. And then 5, enter only after liquidity grab or after a purge, which I'll explain shortly. Let's now go deeper. Fib levels. Fib retracement 2 will give us the end of retracements. However, flow 1 is different to flow 2. We are saying when we get break of structure, this is flow 1 and this is flow 2. We are saying flow 1 is different to flow 2 in terms of marking the end of its retracement. So flow 1 must shoot to 61.8 retracement point and perform a purge. I'll explain what a purge is when we get to the market examples. In this particular case, we can actually say after break of structure on the 4-hour time frame, or basically after seeing a week, we need to see a week of break of market structure, and then after that week, we will need to actually find the market tapping the 61.8. In some cases, it pierces through the 61.8 and perform what we call a purge, which I'll explain shortly. Then flow 2 must retrace and tap the 38.2 and perform a purge for entry. as shown below. This particular case, we need first tip 61.8, second tip 38.2, perform a page and make our entry. How do we enter the market? I'll explain that when we jump to the charts. Before we go to the market examples, please check out our free Telegram channel where we share free signals, free setups, as well as trading advice. The link is right in the description box below. So this is euro against dollar, H4 time frame, which is the weekly ground as I have defined it, the nickname that it is given by the market makers. We've said the first thing is always to find accumulation. On the slides, we said accumulation is basically an MOW pattern or a period where the opening price and the closing price are equal to each other. In this particular case, we can see there was this particular phase where we had an M pattern. A clear nameable M pattern was issued. This clear nameable M pattern had its neckline at this particular point. Neckline, which was later broken. We can see we had a break of structure or a break of the neckline, right? So in this particular case, a break of neckline is actually our first thing to find the market bias, primary market bias. After getting this primary market bias, we've said the break of market structure must be equal to a week of drop, right? Because in some cases, we'll have something like this whereby the market will pretend as if it is broken structure, but later would see it come back to the high of that particular phase. We want to see a week of break, or basically a period that is equivalent to the break of these black traces. So in this particular case, we had half of the week breaking. It was not enough for us to deem this break of structure. We had the other half in the following week where we had a midweek reversal and then a pullback. When the market was now pulling back, it was now time to find the retracement level, Fibonacci retracement 2, and then put at the highest price to the lowest price of our break of structure move. In this particular case, we can see the market went to 61.8 and pierced through that 61.8, created some trap moves to induce traders to go to the upside, but later made a candle closure below the 61.8. So we are saying this particular structure, or this particular off-bound candles, is what we call a page. A page is whereby price moves above a point of interest and then closes below that point of interest. So this particular page is actually good for us to get a point to put our stop loss, which is right above that particular page. So candle closure, which is this point, is where the market, where we were going to make our entry, and where institutions will actually perform their entry operations. As you can see from that particular point, the market actually dumped right to the downside with a very fast momentum, meaning that that was actually it was actually a sign that we had big institutions within the markets, right? After that, we had this now, and now going for another flow. We've said within that flow, we also mark the high and low, and we expect to see the market to come back to 38.2, and on that 38.2 perform another page. Page is basically some activities of candles above the point of interest, which is this one. So in this particular case, we had a candle closure below the 38.2, and we could make our entries. We only trade two flows within a particular cycle to fulfill the market maker cycle, which is basically an institutional market cycle. From there, we also had a start of another point of accumulation. We've said accumulation can be an M pattern or W pattern. In this particular case, we had an M pattern, but unfortunately, after this drop, we did not get a proper reversal. From there, we had another first leg, second leg, meaning this was a W pattern, and then break of structure equivalent to a week, right? This was break of structure equivalent to a week. And after that, we've said we mark the low and the high. And in this particular case, we can see the market came to 61.8, gave us a page, closed above the 61.8 and shot right to the upside. One could actually made 5-to-1 reward to risk ratio and so forth and make some money. Flow number 2 is 38.1, right? Which is 38.2, I mean, which is high, low to the highest price, and this was our point. In this case, we can see they never closed above. They later closed above 38.2 with this spike candle. This is where market makers were introducing their positions within the market, and the market went right to the upside like that. As you can see, this is actually something that is highly accurate. We now have the special point, or the point that I wanted you to see, the point whereby we have an accumulation phase. An accumulation phase, we've defined it as a point whereby the opening price and the closing price of that particular phase is almost equal. We can see that the opening price was at this particular point for this phase and the closing price was at this particular point. We had a break of structure, breaking the low of this whole accumulation phase, and we now had the primary, this was the accumulation phase, we now had the primary direction is down. From that primary direction, we now want to find the end of a retracement. So in this particular case, we can start, we can actually pick our fib level, mark the high of that fib level and the low of that fib level. We can see a retracement to the 61.8 point, and then a page was issued, and that particular page we can see closure of this of the candle below the 61.8, and institutions were involved. We can see these bars are institutional involvement within the markets. Then from there, what did we get? We now go to the 38.2, which was actually at this particular point. There was several candles, closure at this particular point, and then the market chopped. After a market chop, we can see it was actually a small profit entry. Keeping on with more examples, we can start to see that there was a phase of consolidation, break of market structure, pull back to the 61.8, and continuation of market trend. So basically like that. This is how they do it when they are actually executing this particular system of trading. However, if you've noticed clearly that this is not something that anyone can actually do, there is a very popular saying that even if we put this in front of a newspaper, not everyone is going to make money out of it, because not everyone is patient, not everyone is disciplined. Therefore, I actually put forward that you need to be patient and you need to be disciplined for you to make money out of systems like this. But if you force yourself to be disciplined and patient, you find yourself attaining rewards unheard of. On that note, we've come to the end of this video. Thank you for watching, and let me know what you think in the comment section below. Have a good time.